Hi, this is Jean Joe, broker and owner of Perisson Real Estate, where we're all about abundance. Welcome to this week's edition of Perisson Pulse. Today, we'll be talking about Delaware Statutory Trusts, or DSTs, which are an alternate investment vehicle or investment option that you can have as opposed to your traditional rental property. Our guest speaker will be Jason McMurtry, who is with 1031 Capital Solutions. Before he joins us, though, I did want to just remind you that we have our next seminar of the Real Estate and Finance in the Golden Years series. Our next one will be on March 13th in person at the Millbrae Recreation Center, and it will be talking about retirement and relocation strategies. We're going to have two of my favorite speakers, Ron Ricard and Joe Daly, come and speak about the different ways in which you can combine that 121 homeowner exemption along with the 1031 exchange. So I hope that many of you will be able to join us for that. Thank you again, Jason, for joining us. As I mentioned, we're going to be talking about Delaware Statutory Trust today. So with us is Jason McMurtry, who is the founder and managing partner of 1031 Capital Solutions. So thank you so much for being here. And I'm really excited to get into the topic.
Yeah, thank you for having me.
So I guess the first basic question is, what are DSTs? So what are Delaware Statutory Trusts? Can you explain a little bit about how those came about?
Sure. So a Delaware statutory trust is literally a trust. So a lot of people are familiar with a living trust that they might have set up for themselves and their family. And if you do that and you purchase real estate through your living trust, as an example, and you go down to the county recorder's office to see who owns that property, it's going to say that the trust owns the property. But since you own the trust, you own the property through the trust. So a Delaware statutory trust is similar. It's a grantor trust. However, it typically involves 100 or maybe 200 individuals owning pieces of that trust, which then in turn owns real estate. So this is a structure that is typically used for people to invest in fractional interest of property that they can then 1031 exchange into and out of.
Okay, and that kind of answers a little bit of my next question, which is why would anybody want to use a Delaware statutory trust? What are
Sure.
they used for?
Not everybody does, frankly. It's not an investment for everybody out there. It is particularly appealing for people typically that are later in years that have had a very successful real estate career. Typically, they've owned rental property for quite a long period of time. There's been a lot of capital appreciation of that property. Maybe they're producing a lot of cash flow, but they're at a stage in their career where they want to retire from being a landlord. In fact, that's the title of my book, How to Retire from Being a Landlord. And so by selling their property, doing a properly structured 1031 exchange, and then investing their proceeds into a DST or a portfolio of DSTs, they can potentially retire. Because when you invest in a DST, what happens is you're investing in a fractional interest of a property that's managed typically by a large institutional real estate investment company. And they handle everything from the search for the properties nationwide, the negotiating of the purchase, the arrangement of financing, closing of escrow, the property management, the asset management, the bookkeeping. If there's ever an issue at the property, there's an institutional management company that's handling everything. And so from the investor's point of view, what they see is a direct deposit of the net rent into their bank account every month, typically. They see typically quarterly operating reports just to let them know how the property is doing. They get tax reports at the end of the tax year that they then turn over to their accountant so that they can benefit from all of the wonderful deductions that real estate investors receive. So it's really a way to shift from active management of rental property to a completely passive situation. And that's the reason most people do this, is they really want to get out of the business of managing property, but they don't want to just sell their properties outright and pay a 33 or 35% blended tax rate to do it.
Right. Got it. So this is something you can do a 1031 exchange into. Could
Yeah.
somebody actually go into DSTs directly without having investment property? Okay, cool.
Absolutely. Yep.
Okay.
You can do that. And some of our investors have come to us that way. They don't have an exchange, but they want to be invested in real estate because they like the sector. They think there's opportunity. Maybe
Mm,
they like the individual property or the tenants. But the main driver there would be the tax efficiency of the DST. And that when that property sells down the road, that they can then do a 1031 exchange rather than paying capital gains tax.
got it.
So we do have investors that come in direct, just writing a check.
Mhm.
However, we talk to those investors about DSTs, but there are other options that may be available to them as well that may be better suited for them. It just depends on what their individual investment objectives are. But DSTs are specifically structured to allow the investor to 1031 exchange into the DST,
Right.
and then in most cases to exchange out of the DST in the
Right.
future.
Right. Sure. Sure. And just for the purpose of people listening, you cannot 1031 into a REIT, real estate investment trust, but you can into a DST. So
That's right.
why it's a good vehicle. So is there a minimum or maximum investment amount that you need to be able to do invest in a DST?
Yeah, the minimums are typically set by the DST companies. Most of the time, the vast majority of the time, they have a minimum investment amount of $100,000 if you're doing an exchange. Now, if you're not doing an exchange, if you're just going to invest cash directly, typically they'll bring that minimum down to about $25,000. And the reason is because it's an easier transaction for the company when there's not an exchange involved. So they're
Mhm.
willing to take a lower investment amount. Now, some of the companies will have a $250,000 minimum. Some will have a $500,000 minimum.
Mm.
But I would say 90% or so have a $100,000 minimum. And that can be really important because a typical scenario might be somebody comes to us and says, I've got $1 million of equity here from the sale of my property, but that was really a significant part of my overall net worth. And rather than take that $1 million and put it into one DST, a single property, which would be highly concentrated, we can break that up and we could put it into 10 different DSTs if we wanted to, and really get phenomenal diversification. Now, you may or may not want to do that, and we would talk through kind of the pros and cons of breaking it up into 10 different pieces. But maybe 2 or 3 individual DSTs to get some diversification and lower the risk might be a good idea.
Okay, so that sounds good. So I'm assuming that you're not the DST company. You're actually 1031 Capital Solutions is helping people find those properties, right? The DST
That's
investments
right.
and advise them. So can you take us through the process a little bit about if somebody watching this goes, okay, I want to sell my property. I'm tired of being a landlord and I want to maybe look at a DST. Can you walk us through a little bit through that process of what that entails?
That looks like, sure. So a lot of that happens before the investor really comes to the table. So it's happening before an investor is even selling a property and looking at DSTs, is that there are about 50 active DST companies across the United States. We
Oh,
call them
wow.
sponsors.
Okay.
And so these sponsors, they're the ones that are using their real estate expertise and resources to scour the country, to find the best markets, find the best properties with the best tenants, to negotiate the purchases, arrange financing, and close escrow. So they're purchasing these properties and then converting them into the Delaware Statutory Trusts on an ongoing basis. And like I said, there's about 50 of these companies that are really, really active in this market. So 1031 Capital Solutions has access to all of the nationally syndicated DSTs in the country.
Mhm.
So as these companies are creating these DSTs, they send them to our firm and we review them. And we're looking for how long has the company been in business? What is their track record? What is their industry reputation? How well capitalized are they? Their reputation in the industry is really important. And then we look at the property itself. Where is the property? What type of property is it? Who are the tenants? What do the leases look like? We're looking at appraisals and inspections and the financing. And so we'll take that list of maybe 50, 60, 70 DSTs that are available and vet that down to a list of about 20 or 25 options. And we think these are the best 20 to 25 options in the market. And then we put that on a shelf. That's basically our inventory that we would potentially go to when making recommendations to clients.
And if I can interrupt a little bit, so what kind of, is it usually multifamily that you're looking at, or the commercial, or a mix of everything?
Right. Theoretically, any type of commercial property could be a DST. So if some company goes out there and buys a property and converts it into a DST, could be office, retail, industrial, multifamily, hospitality, could be anything as long as it's US property. It can't be foreign property.
Sure.
However, the DST companies are really good at having their finger on the pulse of the market. We're really good at having our finger on the pulse of the market. So if you look at our current inventory of DST properties right now, it's heavily weighted toward brand new or relatively new, high quality apartment buildings in major markets, self-storage, medical office, industrial to some extent, where the tenants might be FedEx or UPS or Amazon. We're not seeing a whole lot of hotels, strip malls, office buildings, because those are out of favor right
Sure.
now. Now,
Makes
maybe
sense.
we fast forward 10 years and things have shifted and those are attractive places to be. We might see more of those in the future. But right now we're seeing a heavy weight toward what generally is considered the more conservative side of real estate, which is your really high quality apartment buildings, self-storage, single family rental, that type of thing. And so what we do is, once we have this buy list, this inventory, then as investment advisors, which is what we are at the end of the day, even though we don't do stocks and bonds and mutual funds, we are investment advisors that specialize in real estate transactions, particularly 1031 exchanges. So a client will come to us and we'll learn all about their transaction. We want to know, what is the timing of their transaction? Where are they in the process? How much equity and debt are they dealing with? What are their investment objectives and preferences? Are they looking primarily for income? Are they looking for growth? Are they looking for safety, diversification, liquidity? What are they comfortable with in terms of property types and geography? And so we take all that information and overlay that with what's currently available through our relationships with all of these DST companies. And then we will come back with recommendations. And that recommendation meeting or call really comes with a lot of education. So we'll go through why we're recommending the DST or combination of DSTs that we are. We go through the fees and expenses, the unique risks in that local market, what we like about it, what we wish we're different about it, because nothing is perfect. Every investment has strengths and weaknesses, and we go over both the strengths and weaknesses. And then we have a conversation with the client about how they feel about everything we discuss. And sometimes we'll help them move forward and get invested. And sometimes they'll say, well, let's go back and look at a couple other alternatives and compare those. And we go through that process. Once the client has decided that they're comfortable and they want to move forward, it's very quick and easy. It could be 3 or 4 days to get them closed. We handle all the paperwork. We work with the exchange accommodator and the DST companies and get everything done. And then we're the advisor for the life of the account. So going forward, when the investor has questions about their statement or their cash flows or a tax report, they come to us and we help them. So that's what the investment experience is like for the investors.
I think that's awesome. I love the fact that you're not just like trying to sell one product, but you're actually there, like your name says, Capital Solutions. So trying to find out the best solutions or best options for your clients. So I think that's really cool. And it's also good to know like that you are keeping your pulse on the market, and that these vehicles or these options may change as the market changes. So I think that's really good as well. So in terms of time frame, so if somebody's investing, do they just hold on to it, or is there a limited time? What are the general times for these DST options?
So the average hold period historically has been around 6 years. And so what that means is the investor invests today, the DST sponsor manages the property. On average, it's historically been around 6 years, and then they sell the property. And when they do that, all the investors are made whole, made liquid, I should say, at the same time. So they return back your equity plus whatever change in value there was. So if the value of the property went up, the investors get back more than what they put in. If the value of the property goes down, the investors could lose, just like any other piece of real estate.
Sure.
One of the tools that the DST companies tend to use, though, is their control over the sale of the property. So if we get out 5 or 6 years and we're in a deep, dark recession and banks are not lending and property is really in a dip, very likely the DST company is going to want to hold on for another year or two, get into a better selling environment so that when they sell, the investors get back a positive return, they have a good positive experience and want to reinvest, frankly. But the returns could go in either direction. So what
And
we call a traditional DST is about
mhm,
6 years historically. The offering documents will tell you 5 to 10 years is the window, your
okay,
liquidity window
that's what
typically.
I was going to ask you is, do you know up front? So they do tell you
They give
estimate.
you a rough idea,
Okay,
right? But we never know this one's a 7 year, this one's a 4 year. It's not like a CD. It's
right.
really at the discretion of the DST manager to
Mhm,
decide when is the best time to sell. And so
mhm,
that's one of the things that we talk to our clients about is, are you comfortable with the fact that your equity might come back to you in 4 years, or it might come
right.
back in 9 years? We really
Mhm,
don't know. And for some people, that's not a problem at all. For
mhm,
other people, it is because they have plans for the money, and maybe a DST is not the best solution for them.
right.
However, there is another route we can take, which is becoming really popular over the
Mhm.
last 5 years or so, which is called the UPREIT. And this is a
The
DST that
up REIT.
yeah, like up and
Okay, up REIT,
UPREIT,
Real Estate Investment Trust.
UPREIT,
Got
right.
it. Hmm.
And it's called that because what happens is you invest in a DST, but
Hmm.
rather than the company selling the property in the open market in 6 or 7 years, it's going to merge up into a REIT.
Hmm. Okay.
And when that happens, there's not a tax bill that's due to the investor. Their DST interest just converts into REIT interest. And
Okay.
so maybe I own one property today, but tomorrow that property merges into a REIT. Now I own operating units of a REIT that might own 200 properties and is worth $7 or $8 billion.
Hmm.
So it's very broadly diversified. It's professionally managed. The manager can do really great things like refinance loans when the terms get better. They can
Hmm.
swap out underperforming properties for better performing properties.
Hmm.
But importantly, there's the opportunity for liquidity on the investor's terms. So if they've been in this REIT for a number of years and they decide, oh, I've got $1 million in there, I'd like to get 10,000 out and have a nice trip, or I want all $1 million out. You can redeem your shares subject to the share repurchase plan, sort of like a mutual fund. So you sell your shares back to the REIT at the prevailing price, which is posted on their website.
Got it.
So
And that could be at any time. So it's liquid, completely liquid.
after a certain period, so you
Once it
have to
gets,
go from
okay,
the DST phase into the REIT.
REIT.
That typically takes 2 to 3 years to
Okay.
happen.
Okay.
And then once you're in the REIT, typically it's a 12-month hold period before you have liquidity. But then after that, you have the potential for liquidity through the share repurchase plan. So
Mhm.
for people that are in their 70s and they're worried about, well, when I'm in my 80s and I have
You might need
medical
that.
expenses,
Sure.
or I want to leave it here forever so that my kids get it, but I want
Mhm.
them to be able to sell it off and divide it when they get it. So these are some reasons why people go the REIT route. Importantly, the drawback to the REIT route, there's strengths and weaknesses
Mhm.
to everything. If you
Sure.
go the REIT route, it has all these wonderful benefits, but you cannot 1031 exchange it back
Right.
into property again. You
Sure.
can't exchange it into another DST or into a property that you find with a real estate agent. You either leave it in the REIT, draw the income, access whatever principal you want, paying taxes on the amount you take out.
Mhm.
You either leave it there or you take it out and pay the tax.
Mhm.
Now, if it's in an estate plan that's drawn up well, and you have in California, a great way to do this is a revocable living trust,
Mhm.
then you get a full step up in basis. So one of the
Oh, okay.
owners, one of the spouses passes away, the surviving
Right.
spouse gets a full step up in basis. The kids are going to get a step up in basis. So all that tax bill goes away. So
Mhm.
depending on somebody's objectives, that REIT strategy can be extremely attractive.
Mhm.
For other people that think they may want to put it back into a piece of property that they
Sure.
own and manage on their own, then the REIT
Mhm.
strategy would not be the best way to go.
Got it. So, but that's an interesting one. But so the UPREIT, that's something that you would know going into it, though, right? Is
That's
that
right.
this is our plan, and that it will eventually get into a REIT. It's not you buy a DST and invest into a DST, and then all of a sudden they say, "Hey, we actually are thinking to change it," but you wouldn't do that, right? In most cases.
Right. So what happens is we go in today, we look at, okay, out of the 25 that we have,
Hmm.
these 15 are really slated to go into a REIT.
Okay,
And the other 10 are not, or whatever.
got it.
And so
Okay.
we know going in, if you say, I want to go into a REIT, okay, here's the set that we look at. If you don't want
Mhm.
to go into the REIT, and we actually know the REIT too. So the
That's true.
DST and the REIT are the same company. So we can
Right.
often look at the REIT and look at their track record and their performance and their composite and all of that to decide. So it's all known up front.
So it's a little bit of a roundabout way of 1031ing into exchanging into a REIT, is
Yeah.
pretty much, right? Because you can't
Yeah.
do that directly. Okay, got it. And it is, so I had a talk with Ron Ricard, who does 1031 exchanges, and he talked about these as well and emphasized that it is a one-way street, that once you get into a REIT, you're not going the other way and back, doing a 1031 out of it. So
That's right. You
good
to
to
get
know.
your money back out. It's a catch. It's like you go into the REIT, wonderful. You can get your money anytime you want,
Right.
but you got to pay tax on
You
it.
gotta pay tax, yeah.
Right.
Which is fair, right? If you're getting
Right.
money out, you should pay tax.
Right.
So what do the costs look like for something like this?
So when the process begins, as I mentioned a little bit earlier, with the DST company, the sponsor, going out and acquiring the property.
Mhm.
So when they do this, they're doing it on behalf of future investors,
Sure.
but somebody's got to pay all of the upfront costs.
Mhm.
And so the DST sponsor pays all of those costs. So when you're buying $100 million property, the seller does not pay the buyer's agent. The buyer has to pay their own agent.
Mhm.
And so and at this level, it's a broker that gets paid. So there's the brokerage fee, which is usually 2 or 3%. If there's financing, there's a point for the loan plus all the costs that go along with that. There's significant amounts of due diligence that go into the appraisal and the inspections and the market research and all the attorneys and all the accountants that put everything together. And so the DST company keeps track of all of these expenses.
Mhm.
And they will add them to the price of the property and sell interest in the DST for that marked up price.
Got it.
Our fee is built into that price as well. So when the company goes out and creates a DST, they incur all of those costs to acquire the property. Then they have to hire an investment bank. We call it a managing broker dealer, but it's an investment bank who engages with broker dealers who have financial advisors, and we're the financial advisor. So all of those costs also get added to the price of the DST. So when it's all said and done, it's pretty typical if a DST property were purchased for, say, $100 million.
Mhm.
Then when you add in all of these fees and expenses, they're going to sell interests for about $110 million. So about a 10% markup on the property is typical. Now, each DST has its own schedule of fees and expenses, and we can walk through that with a potential investor and say, well, this one, these are the fees. That one, these are the fees. And we're fee conscious, so we care about, all other things being equal, going with the lower fees.
Right.
There's a pretty tight band. They're not dramatically different, but they are different.
Mhm.
And so, but the point is, the investor doesn't pay us directly. They don't pay any costs directly. They don't pay for the appraisal, the inspections. They don't pay for any financing. They just invest in the DST, and then the DST uses some of those funds to pay all those closing and syndication costs.
Got it. So then the cost basis of what they purchased, it's already wrapped in the fees, and everything is already wrapped into the cost basis of what
That's right. So the IRS has determined that a DST is 1031 exchangeable, including all of the costs that go into it. So if I invest $1 million, my closing statement says $1 million invested.
Got it. And if you're investing $1 million, you're putting in only $1 million, or are you putting in something beyond that, or what you're getting is the, I don't know, 950 or 900, that in terms of the value of the property itself, or how does
So you're getting the full $1 million. It could even be more than that. So let's say I sold a property for $1 million after I paid my closing cost, brokerage fee, and all of that. I have $1 million of cash after the exchange accommodator fee and everything. So I could take that $1 million and invest it in a DST, an all cash DST. And my closing statement is going to say I invested $1 million. And if the cash flow for that DST is 5%, as an example, that's $50,000 I'm earning in monthly direct deposits to my bank account. But that's how it's working.
Okay.
Now, I could also take that $1 million and invest it in a DST that used financing, used a bank loan to buy the property. And when that happens, when I invest in that DST, I own a piece of the entire property, which means I own a piece of the equity and I own a piece of the debt. So if they had a 50% loan to value, They purchase that $100 million property with a $50 million bank loan.
Mm-hmm.
When I invest in the property, they assign part of that bank loan to me on my closing statement.
Okay.
So I don't have to apply for a loan. I never fill out a loan application.
Right.
I'm not liable for a loan. I don't make any loan payments. It's not on my credit. But the property was purchased with a loan. And so part of that loan gets allocated to me and part of it gets allocated to all the other investors.
Okay.
So what that would look like is if it's a 50% loan to value at the property level, it's a 50% loan to value at every investor's level also. So
Right.
if I put in $1 million, that's 50% of the purchase. They're going to give me another $1 million of debt on my closing statement.
Mm-hmm.
So now I own $2 million worth of real estate. 50% of that is debt, 50% loan to value.
Got it.
If somebody else invests $100,000, their closing statement is going to say 100,000 of equity, 100,000 of debt for 200,000. 50% of that is the debt. So when that happens, I get the benefits of the debt. I get the deductions. I have more money going to work for me, potentially higher cash flow, depending on how the numbers work out. But it's really important for people that have debt when they sold their property. Because if I had $1 million property, but I had a $500,000 loan on it,
Right.
I need to
You need to
purchase $1 million
replace that.
property, but I only
Exactly.
have 500,000 of cash. So I
Right.
can solve for that by investing in a DST that has the proper loan to value. It'll replace the debt for me.
Wow, that's pretty cool. So
Yeah,
it might be a little more complex than people want to hear, but I think that's a really cool feature. And so the takeaway is talk to somebody like you who can help guide them through that. So what happens? I know, so the REITs, I mean, the DSTs, they're not liquid in the sense of you can't just get out of it. But what happens if somebody does? Like they thought maybe 6 years is okay, but the economy isn't doing so well, so it gets extended out. And now they have a need to get out. How would you be able to, is there a way to be able to get out of it if you need to?
If they chose the REIT route up front, that's going to be a much easier way to get out because it's going to be in a REIT that has the potential for share redemptions. If you didn't choose that route, you chose a traditional DST thinking it's going to be out in 5 or 6 or 7 years, and now we're 7 years in, they haven't liquidated it, or you're 3 years in and your life changed, whatever, you need your money. I've heard a lot of people out there say, sure, you can get to your money. Here's what you do. I disagree with that completely, right? My approach, my take on this is this: you can't get out. You can't get out. There's not a traded market for it. You just can't get out. Now, if somebody comes to me in 5 years and says, I know you said I can't get out, but here's my situation. Is there anything we can do? Yes, here's what we'll do. We can call the company and they will send an email to all the other investors on your behalf and say one of your co-investors wants to sell their shares. If anybody would like to make an offer, reach out to them directly. So they'll help kind of put you in touch with the other investors so that maybe somebody's going to make an offer. If it doesn't go anywhere, there are websites that you can go to that specialize in putting buyers and sellers of these investments together, and maybe somebody will buy your shares from you. The reason I really downplay both of those scenarios is they're guaranteed to give you an outcome that you're not happy with.
You're gonna lose money, probably.
You're going to lose a lot of money.
Yeah.
A lot of money. Because you're in a bind, you're in an illiquid investment, and the person on the other side doesn't need to do it. It was your idea, not theirs. So you're bringing them in, and they're only going to do it if they make a lot of money. And these websites that you can go to, it's like hedge funds that they're going to make a killing, right? Otherwise, it's not worth their time. So I start by saying it's illiquid. If you're not comfortable with it being illiquid, then don't invest. However, if somebody is comfortable and their life changes and they come back to me, then we go to these other levers that we can pull, but it's probably not going to be an outcome that makes them very happy.
Got it. Okay. So, so say somebody does go through the whole cycle and they're going to sell, what do they typically do? They usually just go into another DST, or what are you seeing people do from there?
That's a great question. So it's 1031 exchangeable. So they could 1031 exchange into any property. If they had their eye on some property in their city and they want to 1031 exchange and buy that property with a real estate agent, absolutely do that. In my experience, when somebody is ready to sort of simplify and become a passive investor, they're even
They're not
more
going to go
so
back.
7 years later.
Right.
Very rarely do they
Not
turn
coming
around
back.
and say, I miss property management and all the things.
I love dealing with tenants. I
Right.
miss that. Yeah.
Now, where that does happen is sometimes our investors come to us not because they necessarily wanted a DST,
Hmm.
but they began a 1031 exchange. They thought they were going to buy a replacement property.
Hmm.
Somehow the deal fell apart. The clock was ticking, and now they're going to pay a huge tax bill. So
Hmm.
somebody told them about us. They went into a DST to save their exchange, so they didn't have to pay tax. Now,
Hmm.
those people, when it comes out, may go back and buy a direct property, but that's
Got it.
a handful of times,
Right.
maybe 2%.
I see. So most people will just get another DST, go into another DST and just continue that
Right.
cycle and
Right.
maybe eventually just do the uprate for, we're like, we don't want to, well, with the REIT, it would just stay there, right? So it's not a
Yeah.
fixed term period. So is
Yeah.
that what you're seeing people do is actually go into the uprate instead of doing the DST cycles or?
That's right. As more and more people get comfortable with this idea,
Mhm.
they're wanting to do that because then you don't have to revisit this issue every 7 years.
Right.
Because you have to pay another round of fees, you got to do another exchange, you've got to think about it again.
Right.
Where if it was just in a REIT, that cash flow just keeps coming. You have to set it and forget it thing. So for people that feel pretty comfortable that they just want to leave this alone, the
Mhm.
REIT's a really attractive
Okay.
solution.
Sounds good. Well, thank you very much. I think we covered a lot in this session, so I'll end for here. But thank you so much for helping me out with this video, and I
Yeah.
hope that that will be useful. You mentioned that you, just in closing, any comments, and then you mentioned that you wrote a book, so maybe you can share that information with us.
Yeah, and I'm happy to get a copy to you to check out. It's called How to Retire from Being a Landlord. It discusses all things DST, but it goes into a lot of other tax deferral and tax management type strategies.
Hmm.
Really talks about what it's like to be a landlord in today's day and age, particularly in California and some of the Western states where there's rent
Mhm.
control and
Yep.
tenants' rights laws, which I
Yep.
understand why they're there, but can make it very difficult in certain circumstances for landlords. So
Definitely.
um, they can get the book through you or our website, 1031capitalsolutions.com. You can
Mhm.
order it right through there and we'll mail it out to anybody for free.
Great, thank you. So thanks again, and we'll put your contact information and the book information into our YouTube channel.
Great. Thank you so much.
So that's it for today's session of Perisson Pulse. I hope that you found that information to be useful for you. I will have Jason's information put into the description below, as well as the information for his book, How to Retire from Being a Landlord. So I encourage you to read up on that. And I wanted to finally just wish you a wonderful weekend ahead. And if you do know of anybody who is buying or selling, please keep us here at Perisson in mind. Thank you.